The stock market crashes. Banks are under pressure. Investors are panicking. Headlines are screaming. What happens to gold? Does it gold automatically skyrocket? Does everybody rush into precious metals? Or could gold actually fall right alongside other assets, at least temporarily? And the answer might surprise you. I want to welcome you to day 16 of 30 of day 16 of 30 days of gold and silver. And we've officially entered the second half of our series. And today we're answering what happens to gold during a financial crisis. And let's separate the headlines from what can actually happen. So, yesterday, on day 15, we busted seven major myths about gold. And one of the biggest myths was gold is an asset, not magic. And that's especially important today because one of the most common claims that you'll hear is when the stock market crashes, gold goes up. And sometimes gold may perform well during periods of uncertainty, but markets are much more complicated than stocks down equals gold up. So let's understand why. So let's talk about the phrase safe haven asset. Because during periods of uncertainty, some investors look for assets they believe may help preserve value or diversify risk. So gold has historically attracted attention during certain periods involving economic uncertainty, financial market stress, geopolitical conflict, currency concerns, inflation fears, loss of confidence. One reason is that physical gold isn't a liability issued by a corporation. It doesn't require a corporation to remain profitable. And that gives gold different characteristics from many financial assets. But safe haven does not mean guaranteed safe. So gold can fall during a crisis. This is where today's lesson gets interesting because imagine there is a major financial crisis. Investors suddenly need cash, and they may have margin calls and business obligations and debt payments and redemptions and emergency expenses. So what might some investors do? Sell whatever they can sell, and that can include gold. So that's why gold can sometimes really decline during the initial phase of a financial panic. It doesn't necessarily mean investors suddenly believe gold has no value. It may simply mean they need liquidity. So think about a financial crisis like a fire, right? And here's an illustration. Imagine there's a fire. Everybody starts running toward the exit, and they're not necessarily stopping to carefully decide which chair do I want to keep. They're trying to get out. And financial markets can sometimes behave similarly. So when fear becomes extreme, investors may rush toward liquidity. They sell stocks, they sell commodities, they may sell gold, they may sell other instruments. Panic can create unusual short term market behavior. And that's why looking at one day or one week doesn't necessarily tell you the whole entire story. So, what can happen after the initial panic? And this is where things become a little bit more interesting. So, after the immediate panic, investors may start asking different questions. And, what are central banks? Are interest rates changing? Is monetary policy becoming more accommodative? What's happening to currencies? What's happening with inflation expectations? How stable is the financial system? And how much confidence do investors have? And those questions can really influence the demand for gold. In some historical periods, gold has performed strongly during or after extended periods of economic and financial certainty. But again, history gives us information, not guarantees. Remember day three where we talked about central banks? So they do matter. Remember we talked about why central banks hold gold? Gold is one of the reserve assets held by many central banks. And of course, like I was telling you, during uncertain economic periods, monetary policy decisions can influence interest rates and currencies and bond markets and inflation expectations, investor behavior, and all of those can really influence gold. That's why you really can't understand gold by looking at only one variable. Gold exists inside a global financial system, right? And if you look at this point, gold versus cash during an emergency, this is something I really want to emphasize. If there's a financial emergency tomorrow, you'll still need liquidity. I mean, your landlord or your mortgage company isn't necessarily waiting for you to figure out how to liquidate an investment. Your electric bill still comes, groceries still cost money, and emergencies still happen. So that's why I've repeatedly said throughout this series that gold doesn't replace an emergency fund. Physical gold can potentially play one role in a broader financial strategy. Cash can play another. Stocks can play another. Real estate can play another. Different assets, different purposes. So diversification, this is a point I want to make here, that diversification really is about not knowing the future. And this is one of the biggest lessons of our entire series. Why diversify? Because we don't know exactly what happens next. If we knew with certainty, your stock would win, or what would your goal do, right? Where would interest rates go? And like I said, would your stock win or would it not win? What would inflation be? What real estate would do? I mean, there wouldn't be much need for diversification, but we don't know. Diversification is an acknowledgement of uncertainty. So it sure doesn't guarantee a profit. It doesn't prevent losses. It simply helps us think beyond one asset and one possible future. So for me, learning about gold isn't about preparing for some doomsday scenario, right? I'm not sitting around hoping the economy collapses so my gold goes up. That's just not the mindset. I'm interested in understanding how different assets can potentially behave under different economic conditions. Because gold, my goal isn't fear. My goal is preparation. I mean, and there's a huge difference between those two. So here's today's wealth principle. Prepare. Don't panic. Don't wait until everybody is scared before learning about your finances. Don't wait for a recession to start understanding diversification. Don't wait for inflation to become uncomfortable before learning about purchasing power. And don't wait for a market crash before deciding what your strategy is. Build financial knowledge before you need it, because decisions made from education are usually very different from decisions made from fear. Now, if you're studying gold during periods of financial stress, don't simply watch the gold price. Pay attention to the bigger picture. What's happening in financial markets? What's happening with currencies? What are central banks doing? What's happening with interest rates? What are inflation expectations? What's happening geopolitically? What's happening with investor sentiment? And importantly, what's happening with your financial situation? Your personal financial plan matters more than today's headline. So let's recap. Number one, gold has historically been viewed by many investors as a potential safe haven and diversification asset. Number two, gold can still decline during a financial crisis. Number three, investors sometimes sell gold during panic periods because they need liquidity. Number four, monetary policy, interest rates, currencies, inflation expectations, and investor psychology can all influence gold. And number five, gold shouldn't automatically replace cash, stocks, real estate, or other assets. And finally, preparation is different from prediction. Now, I want to hear from you. When you hear the words financial crisis, what's your instinct? A, hold more cash. B, buy gold or silver. C, buy stocks at lower prices. D, diversify across several assets. Or E, I honestly don't know yet. And this isn't one universal answer that you have to give here. I mean, you can just put A, B, C, D, or E in the comments and just tell me why. And if you'd like to learn more about physical gold and silver and explore the platform that I personally use, you can visit the link in the description. Like I have been saying for 15 days, don't make a financial decision because you're afraid of the next crisis. Learn how ownership works, understand pricing and cost, understand storage, understand liquidity, understand delivery, understand the risk, and decide what makes sense within your broader financial plan. And if you're enjoying 30 days of gold and silver, hit that like button, subscribe, and share this episode with somebody who thinks gold automatically skyrockets every time the stock market crashes or falls. Because tomorrow, we're going back in time. In day number 16, we're talking about gold throughout history, ancient civilizations, empires, gold standards, modern currencies, central banks. We're going to take a journey through thousands of years and see why gold has survived financial systems that disappeared long ago. So I'll see you in day number 17. And before I go in closing, remember this, that financial preparation isn't predicting the next crisis. It's building enough knowledge, liquidity, diversification, and discipline that you don't have to make every decision from fear. Guys, again, this is Billy B. Josie III. I am president and CEO of Stoneleaf Ventures LLC, where we help everyday people create generational wealth and legacy through gold and silver and digital marketing. I'll see you in the next video, guys. God bless.